Righto, buddy miners, we've got an M&A special. And, well, technically, I'll probably pick the wrong one here because it's an M&A Howlers special.
Best.
But possibly the greatest M&A of all time was done by Sandvik for the ground support division. So it's like the opposite of what the show's about. But acquiring DSI is M&A spectacular because getting DSI, the ground support division, in means they pretty much got Derek Hurd for free.
Derek came for free, and mate, that's vertical integration. I mean, you were a jumbo operator in Sandvik machines, and now guess what?
Sandvik machines jamming in Sandvik bolts, brought to you by Derek Hurd and the team at Sandvik Ground Support.
Derek alone was worth the 1 billion euros they paid.
I don't think.
No doubt about it.
Sorry, maybe I said it wrong. They got the ground support division for free. They paid a shitload for Derek Hurd. Yes, go Sandvik.
Money well spent.
Go Sandvik Ground Support. Let's get into the M&A Howlers episode. Righto, buddy miners, we've got a JD spectacular. M&A disasters, it's titled.
Yeah.
M&A mishaps, should we be a bit more positive? Nah. Disasters.
I think there's a silver lining in most things, Matty. I did come at it wanting to learn about disasters, specifically the Riversdale one. But yeah, for the money miners, we're going to talk about 5 of the most value-destructive deals in our industry and hopefully learn a thing or two along the way about the history, about what you can do better as an investor, about what mining companies can do better along the way. So it's a bit of a walk through mining history.
The best way to learn bad capital allocation is pull out these case studies and say, I'm not going to do that.
Yep. Same can be said for stuff on the good side as well, which we'll get to in due course. But there's a one or two things, to say the least, that can be learnt from some of these mishaps, as you said. Matty.
Yeah. So what went towards the shortlist, JD? How did you determine what was value destructive and what wasn't?
It was a bit sort of scattergun at first. So I decided to make a bit of a criteria for it and then go from there, because there's loads of different things that have happened over a very long bit of time. So how I kind of went about it was deals that have happened in the last 30 years and, not very recent ones either, because they really haven't had the appropriate amount of time to run their course. You need a bit of a cycle or two. And going beyond 30 years gets kind of hard on the research side of things. Hard rock commodities, so the likes of BHP and Freeport venturing out into the oil and gas world can be thankful. We're going to keep to what we know, the hard rock mining side of things. Also, this is a kind of big one. They had to be an Aussie company doing the buying. So not focused on other deals. Maybe there's another episode in that in due course, because there's some very interesting deals that international businesses have done. But this is an Aussie company doing the buying.
Aussie based or Aussie listed or both? Or
listed. Yeah. Another big one is focusing on out and out errors rather than kind of errors of omission. So I'm not talking about kind of selling an asset at the worst possible time, at the bottom of a cycle. They're big mistakes as well, and you learn from them. But we're talking about deals that were actually done and that resulted in big kind of financial downside rather than foregone earnings kind of.
The flip side of this is the sellers of all of these deals had a great deal.
They generally did, yeah. The silver lining to everything, right? And the last couple bits and pieces is that they're not bad projects. This is deals. We're not talking about projects that a company had and sunk money to that didn't quite go so well. And yeah, I guess a feature you sort of pick up along the way that, the cash and kind of script component, can often end up being a worse deal depending on the structure of that deal. So that played a bit into the actual ranking of the 5.
Very good. Righto. Take it away. Is these in order of least shittest to most shittest?
I'll talk through the ranking real quick because it is super hard and pretty subjective, to be honest. I'm sure anyone could change the order as they kind of see appropriate, as well as change out the 5. There's a little bit to choose from, and it's kind of hard, Things kind of change over time as you sort of pick up in the deals and how badly they were rated, that can change. Say there's a commodity uptick and maybe it's not quite as bad because you get a bit of compensation down the track. But just to speak to my thinking, I'm thinking of a combination of how much money was sunk in, particularly as a proportion of like your business side, if you being the buyer are going towards it. Was it 5% of your market cap, or are we talking about 35% of your market cap? what kind of state that left you in as well factored pretty heavily in my thinking. If you were able to ride it out kind of fine because the commodity cycle continued to power on and took you through, then maybe it wasn't so bad. But if that was funded via debt and left you in a pretty perilous state and in, very, very bad shape in some of the cases, then that doesn't go well toward the ranking. So yeah, all of that deal size, what time in the cycle, company's ability to recover, what happened to the management team and the executives afterwards. Did they sort of go on the chopping block? I did kind of think about the rationale from executives, how they thought about the deal, how outrageously confident some of them were
there
at the
perverse
time.
incentives that motivated it?
Yep, that definitely factored in. So,
oh mate, I'm hanging on to me seat, JD. Come on, rip in, mate.
All right, let's start. Number 5, Matty. Newcrest buys Lihir Gold.
Ooh.
So a big gold deal. We're going back to 2010 for this one. Gold, I'll set the scene, tearing higher, coming out of the GFC, so to dip down 2008-9. It was around US 700-ish in that kind of range in late 2008. And by the time they're starting to talk about this deal and it's getting announced in April of 2010, gold is approaching US $1,200. So
right when Northern Star bought their first gold asset, nearly.
Yeah, there was this sort of 2010 to 2013 period was huge in shaping the landscape of the gold industry. So Newcrest is the buyer here. They are the big Aussie gold champion, as everyone kind of knows, capped at about 15 billion bucks at the time, in a time where one Aussie dollar was buying you about 92-ish US cents. So they've had, Telfer, Cadia, Krakow, Hidden Valley and Gossawong as their operating assets at that point in time, doing a bit over 1.6 million ounces.
And that was the heyday. Like that was like the Telfer sub-level cave when it was pumping.
Stock is at an all-time high when they're going into this deal. And then you've got Lihir Gold. So they, again, an Aussie-listed one in this case, they're getting towards a $7-ish billion Aussie market cap pre the bid.
Wow.
They expanded the gold resource at Lihir by 30-odd% in 2009, so the year before the deal, to a resource of 43 million ounces. So looking very, very pretty for a prospective buyer there. And Lihir was their crown jewel. It was about 75% of their earnings. They also operated Mount Rawdon and Bonnet Crow. So 1.2 million ounces, not actually crazy amounts smaller. It's just the sort of jurisdiction and the nature of those ounces and the profitability that leads to the desperate market caps between the two companies. One other thing to bear in mind in the context here is the resource rent tax. A big deal. We had Gina, Twiggy, High-Vis marching down the terrace. This was huge in this time, and it led to a lot of the operators looking overseas as opposed to in Australia because they were scared of what a potential taxation environment might do to an asset here.
Gotcha.
Yeah.
It's a short term. You're thinking, I've got to diversify my earnings overseas.
Yeah, the economics just look comparatively a bit better. So the deal itself, April Fool's Day, actually, in 2010, LGL, that's Lihir, rejected a scheme of arrangement from Newcrest. And funnily enough, this was the same day that Lihir had a new CEO take charge. So this CEO did quite well for himself, $4 million he earned in a 4-month stint at the business. Newcrest were
$10.
Yeah. Back when it meant something. Newcrest were offering 1 share for every 9 LGL shares plus a cash kicker in there. So they valued Lihir at $9 billion, which was a bit over a 30% premium, your kind of standard premium. But it was revealed in the docs that they'd actually had a swing a couple months before, and this was a 12% increase on their previous bid. So a more than $1 billion to the price tag.
Who revealed it, JD?
It came out in the docs that I think had a Newcrest tag on them.
But the very first public announcement, did it come from Newcrest or did it come out of Lihir?
It came out of Lihir saying they had rejected the proposal. Yeah.
Gotcha.
And then, both of them come out with an announcement on the same day and subsequent as well. Regardless, Lihir wanted a price bump and ultimately they would get it. So you've got this sort of classic period in takeover games where Newcrest just stresses their cost discipline, how they're, going to be very disciplined in their approach to how they pay for Lihir. And LGL is just telling the world why the bid undervalues them. So in the background, gold continues to tear higher actually, and it actually finishes that year at close to $1,400 an ounce. So a pretty mighty movement in the space of about 2 years on the gold front. Give it a month or so and the deal reaches its kind of conclusion. Newcrest improve it again. They value LGO at about $9.5 billion. Cash makes up about 500 of that. And a few months later, the deal closes. So
they accept it.
Did, and the merge co ends up being about 36% LGL, and the remainder were the Newcrest shareholders who gobble them up in this merged entity, and they go to a net debt position of about Aussie 300, which ends up blowing out because CapEx needs to be spent, which I'll get to. But this creates the fourth biggest gold producer in the world.
Wow, that is phenomenal, just saying that percentage pro forma, just considering the assets. That is unbelievable.
It is, right? So interesting. So thinking about how Newcrest's management pitched this deal to its own shareholders was kind of interesting to read into. They're saying we're buying a heap of ounces and we're buying them cheaply because they're in PNG, of course. And they're also saying that these ounces are going to be low cost to produce, which is something that doesn't ultimately end up really being true. They're talking about geographical diversification as well. And all up, it's pretty light on synergies. There's not awful, aside from the corporate side, of synergies taking place in this deal. They do stress that their experience in Indonesia will help them handle the complexity of Lihir and operating in that part. But they lay out this beautiful growth picture. They're going to 3.75 million ounces in 5 years' time. And, sadly, they only end up getting to a bit over 60% if you look at the FY 2014 numbers and how it actually compares at that point in time. They didn't get anywhere near it. They just wanted a much bigger production profile. And this was a roaring gold bull market. Like, we have to really let that sink in. Things were going gangbusters. These guys, all the gold industry is hitting all-time highs. Gold is higher for longer. People are pumped up, and management is sort of rationalizing this deal because, in their words, it positions Newcrest to fully participate in the current strong gold price environment.
And would that have been the same time when Porgera was probably pumping for Barrick in PNG? So PNG would have,
I believe so,
appeared to be a friendly-ish jurisdiction.
Yeah, so 2010 to 2015 was an interesting time for PNG. There were, once it comes into Newcrest ownership, a fair few disruptions, protests. It didn't tend to hold up the mine for too long, but it did seem the years later were a bit more disruptive. This block was picky, but I think the economic regime was a bit friendlier at that time, so it has changed a bit since then.
So what went wrong?
A combination in this deal made things really go pear-shaped. Firstly, they got the cycle wrong, and that wasn't apparent at first glance because they had awesomely profitable years in 2011 as well as 2012. They were the most profitable years in the company's history. And, you had that beautiful period, kind of like where we're at now, where the gold price runs and costs just can't keep pace with the run-up in the commodity price, and you actually get outsized returns for a year or two before things catch up. And 2013 saw the gold price down 30% in that 1 year alone, right as the company expanded onto a massive CapEx cycle. They wanted to hit those more ounces that they'd promised. So the excess returns from those 2 years didn't go back to shareholders. The intentions weren't kind of bad, but they got the timing wrong. They spent US $1.3 billion on CapEx at Lihir. That ended up blowing out, ended up being more than that, and it ended up coming much later than planned as well. They wanted to hit 1 million ounces per annum, and they just never reached those levels at Lihir. It was just all round slower and more costly than they had anticipated. And the operating costs, this is the expansion I'd mentioned, but the operating costs didn't meet the target either. Then you've got those community-related challenges at Lihir that I just touched on, as well as this kind of interesting bit of news from 2014. This wasn't a huge impact. I kind of got sidetracked because I found it so interesting, but there was a very well-publicised selective disclosure fine that Newcrest had to pay what this was the investor relations team telling analysts to chalk down your capex, lift your capex numbers and chalk down the production numbers because we're not going to make them, and they try to sort of soften up the market. And there ended up being a class action lawsuit, and nearly a $40 million fine got laid on the company because you can't do that at the end of the day. So there's a lot of people I know in the industry that know that one quite well. It wasn't a good sort of sequence of events, and it didn't reflect well on the sort of company itself. The actual fine from ASIC was pretty paltry, but the sort of backfall from that was pretty gnarly.
Was a lot of the miss in ounces, was it metallurgically related? Because it's a POX operation, isn't it?
Yeah, that's right. Take your pick. There was challenges.
Just everything.
Yeah, there's challenges on a lot of different fronts there. To speak to the other two assets, because I said Lihir was 75% of the earnings, Newcrest sold Mount Rawdon and its Krakow stake to a group that ends up being Evolution. Very interesting deal. So that happened in 2011. They
have to do that? Was that like because the capex and debt issues at that time?
Nah.
They chose to do it?
They chose to.
Wow.
Like 2011 was the good times, and that was just rationalisation of the portfolio. They ended up having a stake that was north of 300 million at the time, but they sell that 3 or 4 years down the track for a bit over 200. So it wasn't sort of executed so well. And that other Bonikro asset in West Africa was cashed in for $80 years later in 2017.
So what happens to the executives that were part of putting this deal to the board?
Well, this is an interesting one, and we'll see a repeat of this. The CEO left very shortly after the deal in 2011. So at the time when that CEO left, things were looking pretty cruisy. Ultimately, though, on an accounting front, the Lihir assets get impaired by $4 billion just 3 years or less than 3 years after the deal in 2013, and then by a further almost $3 billion a year later. So that is a pretty hefty write-down.
Is that when Sandeep come in, I assume?
2014-15.
Oh, so he didn't replace the CEO in 20.
No.
Okay, yep.
So they paid $9.5 billion, and within 4 years, $7.9 billion is impaired. Plus, they would have spent a bunch on capex as well.
Yeah, and if you want to try and be friendly to Newcrest, just Google write-downs 2013 gold industry, and there's a top 10 list, and they're all disastrous. That's what happens when the gold price peels off massively. Yeah. The impairment is an accounting thing, but it doesn't reflect well, and the assets were nowhere near as profitable, and the opportunity cost from giving away 36% of your business is just phenomenal. So the stock goes from about $40 a share to below $8 in 2 years' time. 10 years later, it gets taken out at $23. There was about $4 of dividends paid in that period. But yeah, it was very, very tough. Newcrest generated cumulative free cash flow over that 5-year period, 2010 to 14, of negative $2.5 billion. Operationally, there wasn't a single year after completion until Newcrest got taken over in 2023 that production met or even got close to really that target that they set in 2010. Not a single year in 14 years. So Lihir is an asset that's still producing for Newmont, so it's not a complete flop. In these sorts of prices, it makes money again. That's perhaps kind of why it's ranked 5th. But the opportunity cost there is just massive, and I think it's the sort of quintessential example of that 2010 era gold M&A.
Yeah, very good, JD. Deal number 4.
We're going to America. BHP buys Magma Copper. This is the oldest deal on the list. This deal happened in late 1995, and amongst other deals that BHP did at the time, it took the big Australian to their knees in the late 90s, which was really, really interesting to learn about.
I'm fascinated, mate.
So we'll give a bit of context to sort of set the field. BHP wanted more copper. So old story come new. And as it is a bit of a theme on this list, 1995 was an absolute record year for copper prices. So it's tearing ahead. It's over $1.30 US a pound. Now, Magma, importantly, was not just a miner. They had smelting capability, and BHP didn't have that. So that meshing of concentrate and downstream capacity, very similar to what we're seeing today with the changes between who has the power between the concentrate producer and the smelters. was a big factor in this deal. Magma was a spin out of Newmont. So they came out in 1987. They were their own kind of entity, subsidiary that became its own thing. They owned 3 mines in southeastern Arizona. Some of these names might be familiar. You've got San Manuel, that came with a smelter as well, Superior and Pinto Valley. And then you've got Robinson in Nevada and Tintaya in Peru, which I'll explain later, will also be familiar to a lot of the listeners out there.
Very America's focused, well, North America, a little bit of South America there.
Yeah, 8th biggest copper producer in the world. And there's this this headline sort of at the time, Magma was the acquisition that BHP had to make to meet its voracious copper demands. So that ability to get the smelting side of the business can't be understated. It's a key part of why they did this deal. And the San Manuel smelter in Arizona there was the biggest in the US, and it was capable of being expanded. They had big plans for that one. So that was the crux of kind of why they did this deal. Magma itself had gone through a really, really tough time in the 80s, but they'd turned that around coming into the 90s, and they, up until this deal, those sort of 5 years, were making really good money.
Also, well, record high copper price probably helped at that period in time.
Helped massively. No surprise.
So what was the deal?
So BHP pays over Aussie $3.2 billion, and Magma came with US $600 million in debt.
Gotcha. They've assumed the debt, yeah.
Yeah. So this makes BHP the largest publicly traded copper producer in the world, with about 10% of world production. They paid a 30-odd% premium, kind of the standard, and it was relatively clean because they got that off well-known US group Warburg Pincus in the sort of banking world there. They paid cash for this deal, mostly using their cash reserves, but they also tapped up their existing credit lines. So if you annualize Magma's previous quarter's earnings, they're coming out at about US $200 million. And like you said, Trav, we're talking about a time with record prices. So given how much they paid, it already looks pretty chunky. You're already factoring a fair bit of growth. And there was this sort of New York Times headline from a quote from, I think, a broker at the time saying, "I couldn't believe they paid $3.2 billion." So
it's 16 times earnings.
Yeah.
Yeah.
Doesn't look good.
In US, it's 2.4. So it's 12.
200 million.
12 times peak earnings. Well, yeah.
With that debt coming in, it screened a bit expensive. So
okay, so where did it go to shit, JD?
So this one is a bit unique versus the other ones I'm going to talk about. The first thing I'm going to focus on is the cultural disaster that this one was. There were serious failures to integrate the team and manage the mines appropriately. So obviously this one happened a long time ago. I'm working off a lot of commentary that was given by people that worked at Magma Copper as well as at BHP at the time. But Magma had a super regional Arizona identity, as I sort of understand it. And worlds away, you've got BHP execs making the calls. So you could add to that the argument that BHP has a bit of a bulk mining mindset. I think that's kind of warranted. They made a lot of their money, obviously, in iron ore as well as energy. So what they were doing here was not what they were doing. It wasn't their sort of classical way of operating. It needed a bit of different thinking, and it didn't really get that. So a lot of accusations of BHP being pretty arrogant and a bit too rigid in their management in this one. You've also got to look at the fundamental issues with the DD that BHP undertook, and what I'm kind of getting at is the assumptions for how much better they thought they could run the assets than was currently being run. And I think that ties in with the arrogance kind of point in a way. They thought they knew a lot better than the locals on the ground there. And I think this comment from a Magma exec just captures it perfectly. Magma had mediocre assets run extraordinarily. BHP had extraordinary assets run mediocrely. So that, to me, just tees it up kind of perfectly. So adding to those cultural challenges, you've got the commodity cycle. They bought this asset at an all-time high price, and that's usually not a recipe for success. So no exceptions here. And it's like you sort of see often in the corporate world, the sense of FOMO is not that different to your regular kind of retail punter. Everyone's human at the end of the day, and that was very much a factor in this deal. Copper was trading near 60 cents ultimately when BHP pulled the pin, and that was not a long time later. That was just a short few years later. So their conservative assumption in this deal was that copper would not fall below $1 a pound. And in reality, these assets at 95 cents were losing money. So it was very interesting for me to learn that copper hit a century low in inflation-adjusted terms in 2000. So that completely whacked them round, and any chance of synergies were kind of wiped out with the assets not even running because they shut them down. So
they shut all of the assets down.
Pretty much, yeah.
Wow. Even with smelters aren't easy to restart.
It takes a bit of time, and I think I sort of go through a couple of the assets, but I got very sidetracked with a couple fascinating things, right? So you've got the Asian financial crisis happening in 1997, so this added to the fall off in copper prices, and there's this story about this trader at Sumitomo, which is very, very fascinating in my opinion, and this completely shook around the copper market, and it impacted BHP in the sense that earnings obviously just went through the floor. This could be worthy of its own episode, but long story short, you've got this commodity trader from Sumitomo in Japan. His name is Yasuo Hamanaka, and he essentially traded on an unauthorized account for over a decade and just hit everything he did. This started, as it tends to, with him trying to make up earnings that he'd had, or make up a loss that he'd done in, I want to say, 1986, a long time before. And how he tries to make up those earnings is by cornering the copper market using a whole bunch of futures, warrants, and other instruments. And this is the copper market we're talking about. It's a big market. It is a big market. And eventually, in about 96, he manages to get credit lines to the sort of tune of US $150 million from over a dozen banks, not cumulatively each. So this all just implodes massively in mid-96. And then there's this investigation at the time to what's going on in LME warehouses because the inventories are just draining, and this kind of sparks a kind of rush. The copper price falls 40% as Sumitomo try and unwind their position. They end up copping a US $2.8 billion loss in 1996.
Wow. Holy shit.
Yeah.
Wow. And he's trying to squeeze the market.
He was trying to squeeze it higher, but it went completely tits up, and then they had to sell everything.
Wow.
So,
oh man, that's an incredible part of history.
Yeah, I mean it's going to happen sooner or later, but yeah, there's a whole bunch of other alleys I could get sidetracked down, but we'll stay en route here.
Don't worry about that, JD. This is interesting.
There was a bunch of other mishaps for BHP that hit them like a truck all at the same time, and I'll just mention a couple of them. But you've got the HBI plant, which was a complete and utter disaster in Port Hedland, and it sadly ended in the loss of life with an explosion there in the early 2000s. That cost them $2.4 billion.
What's the HBI plant?
A hot briquetted iron plant.
Okay.
So, kind of what other miners are talking about these days. They were trying to do that there. It was $2.4 billion used to mean something for BHP. That was a big amount of money, just like this deal. And that just didn't work whatsoever. They had the Hartley Platts mine in Zimbabwe that cost them $700 million. Octedi, complete and utter disaster. No other kind of way to put that one. That they eventually got out, pretty much giving away their stake and paying a heap. So they kind of came out with a $2 billion loss on that one. And added to that, you've got pretty much every commodity in which they're operating hitting cycle lows at the same time. And they had this big theory that could never happen, and it did happen, and it was a disaster. And they reported, get this, their second ever loss in their 100-year plus history, losing $1.5 billion in 1998. I mean, it's a credit to them that that's only their second loss, but it all came at the wrong time for BHP.
God, it's alarming when you talk about these points in history and you're like, shit, imagine if that happened now, which it could.
It's crazy.
Because it's happened, and it does happen, but you just never think it's possible, just like them.
Yeah, I mean, think about how quickly this one unraveled. $550 million in write-offs within a year. Like within 1 year of having the mine. In 1998, just 2 years after the deal had been announced, they wrote off nearly $1 billion more. The whole deal was completely written off by 1999, and including rehab costs, the losses far exceeded what they initially paid. We're talking over $4 billion on this. The operations were never profitable for any sustained period at all, and very unfortunately, it led to an enormous amount of layoffs and kind of obliterated the community there in Arizona. And as you'd expect, it led to a fair bit of animosity toward BHP. By 2003, the BHP had closed the Sandeman copper smelter, which was the crown jewel, and that ended a 50-year history of operating there. So there's a bit of a silver lining, though. They did manage to sell, during the next copper upcycle in the China boom, the Tintaya copper project for $700 million. This was sold to Xstrata and came with Antapaccay, which people will know is a big producing asset for Glencore now. So that wasn't being mined at the time, that was 10 kilometres away. Pinto Valley was sold to Capstone Copper a long time later with all its liabilities for $650 million. But we're talking nearly 2 decades after the deal at that point in time. And BHP's ownership in Resolution Copper also comes out of this. So people thinking maybe sooner or later that gets put into production, but as it stands, it's been 20 plus years and billions sunk into that one. So the payoff from back then is just not a bet you'd want to take.
So is Resolution below the old?
Kind of, yeah.
Yeah.
Yeah. You can.
Yeah, right.
Yeah, I think I put a map somewhere. They're all in that kind of area. Resolution is deep.
Yeah, yeah.
So it's in the same ballpark. And a few of these assets changed names over time, which infuriated me like crazy doing the research.
I can imagine.
Yeah. So on the management side of things, you've got the chairman and the CEO both leaving not long after the deal, and then as they put it in BHP history, they've got the dynamic duo. These two Americans, Paul Anderson and Chip Goodyear, came in. Each had a stint as CEO. Chip was CFO to start with. They immediately just went on this program. They sold about 30 different assets, raised a bunch of money. A bunch of other board members got let go at the same time, or sort of made to resign. So this was a hugely influential period for BHP, and really changed the mindset from being a kind of Melbourne-based company to a global company with these Americans coming in and running the show. And the company's been quite different since. Between the Magma deal and the Port Hedland disaster, they lost nearly $7 billion. So BHP was a less than $20 billion company at the time. So these were very significant sums. And what comes out the back of this in sort of early in 2000, 2001 time is that they do the deal with Billiton, and that is done at a much friendlier ratio to Billiton than it would have otherwise been done had they not had all these disasters. And Billiton didn't have great assets, but their management team came in and ran BHP afterwards.
So that's in, so what did Billiton get as a proportion of the pro forma when that deal was ultimately done?
God, I want to say 34%.
Yeah, that sounds familiar. So even though this deal didn't come with dilution like the last one, the impact was still horribly dilutionary to shareholders, because the ultimate share for existing BHP shareholders of the pro forma BHP Billiton was substantially reduced.
Whacked them.
Wow.
Yeah.
Wow.
So that was a juicy one.
Yeah. And what did its share price look like in this time?
It fluctuates a lot. So we go from $20 in sort of 98 to 2000 period. It's $8 at a time. It bounces around a lot, and then 2001, 2, 3, 4 kick in.
China.
And it's blue skies. Happy days for everyone.
Yeah. A quick break to talk about M&A at K-Drill. Because why wouldn't you? Think of the M&A that happened when they bought Ryan O'Sullivan.
Was he for sale?
I compare Ryan O'Sullivan, because I don't know if he was or he wasn't. He's Voices Bay. Voices Bay, the big competition that Robert Friedland got going for that nickel asset. That was probably going on in the background for Ryan O'Sullivan. K-Drill have come up with the goods, and what's Ryan brought to K-Drill? The bloody sample management, the drill budget management. Everyone wants to work for him. And this was all happening before we even started talking about him, a legend of the drilling industry. And he is a great M&A play by K-Drill.
The Voices Bay of
exploration
of
drilling.
exploration RC drilling.
His
Rhino
voice's pay still going good?
Yeah.
Oh, that's all right.
T1. T1
It's
asset.
it's more the bidding war, right? People were just tripping over, weren't they, Matty? They were tripping over to get a piece of him.
Mate, if voice's pay's still going in a depressed nickel environment. So that shows how good Rhino Sullivan is effectively.
Why wouldn't you want to trip over yourself and try and get hold of Rhino Sullivan to drill some holes for you?
Trip over him while he's drilling the holes with his bare bloody hands. Right.
Go K-Drill.
Let's get back to the JD Spectacular. Very good. Right. I wouldn't have picked this was number 3 just because it's the one that seems to get talked about the most.
Yeah. And this is probably what sparked my interest in doing this kind of episode, Matty. Rio Tinto buys Riversdale.
Right.
So, got Riversdale on the one hand. This is a company created by a well-known operator, Michael O'Keefe, and a few others that were the sort of founders there. They're the proud owners of a 65% interest in Benga Coal. They also own the Zambezi project as well, which is very close. I'll show on a map here. Benga Stage 1, which is under construction at this point in time, is targeting a bit over 5 million tonnes per annum coal production. Stages 2 and 3 are targeting a further roughly 15, so that'll take them up to 20 million tonnes. Those 2 stages are PFS. Then you've got the Zambezi conceptual mine, which is, just blue sky, meant to add over 40 million tonnes per annum to the profile to really biff it out. This is all in the Motis Basin in Mozambique, which will make a lot more sense if you look at the map there. The Benga project reportedly held 14 billion tonnes of hard coking coal at a time when coking coal was fetching record prices. That was to do with China and everything, but you also had this flood in the Bowen Basin, which was giving a bit of a supply shock to the market. So to round out the interests, you've got Tata Steel, who will play a key role. They own the other 35% of the operations. They also own 26% of Riversdale stock. So they're very key in this takeover battle. And you've also got this Brazilian group, CSN. They own a bit under 20%. So Riversdale, here's a fun fact, also owned an operating asset that produced 700,000 tonnes per annum in South Africa. This was the asset that was bought by none other than Vuslat, who we just interviewed in South Africa. Yeah, so he buys this one off Rio in due course. So it all comes together.
Oh, there you go. You added that bit in after the Indaba trip.
Well, I had that in there and then I added the name. I was like,
well, that's you.
Yeah, it all came together. So the deal itself, it's a bit of a Christmas present. December 23rd, 2010.
Wow.
Riversdale shareholders get, kind of the gift of all gifts. There'd been speculation building for some time, and you'll see in the share price chart that I'll show here what it had kind of done to the stock. It was revealed in, I think, April of that year that Rio's head of energy recommended to the board that they should try and acquire Mozambique coal assets, with obviously these guys, Riversdale, being the key kind of company in that area that was playable. Rio agreed a $16 share price, valuing the fully diluted equity at Aussie $3.9 billion. So a 46% premium to the undisturbed VWAP on this company, and this was Rio's biggest deal since Alcan. In the takeover announcement, you've got them sort of saying that the Benga project is expected to commence coal production in September 2011, and Zambezi would start sometime after 2014.
Gotcha. So they're thinking we're buying this with 9 months left to production.
Yeah, this thing's in construction and it's going to be producing coal very soon, and we're going to start to bear fruit on this price tag because it's a ripper coal pricing environment. The deal wasn't done though. So by March of 2011, Rio had to up their bid by 50 cents to $16.50. They said, that's as high as we're going. This takes it a bit over $1 billion, EV of $3.5 billion, given there was about $500 million in cash on the company to fund the rest of their construction. Rio went unconditional, and it's them trying to win out with Tata Steel, as well as that other group, CSN, and in due course they get there. They get CSN over the line first, and then it takes about half a year from when they first announce it, but they take the stake off Tata, who didn't want to be part of this without a sort of proper JV structure to it. So they just sell into it, and Rio put in place this strategic objective, 25 million tonnes per annum of hard coking coal by 2020. So a bit of a ways down the track, but that's what they're striving for.
Are they thinking, we're seeing this enormous growth of demand for our iron ore come out of the Pilbara? We need to beef up our hard coking coal portfolio to match that, and we'll be supplying all the things that go into this huge steel demand.
Yeah, in a nutshell, they have this strategy of just servicing China, and previously that strategy had been aluminium, iron ore, copper, and then coal gets added to the piece to fill out that growing demand profile and be in the next hot basin for coal, Mozambique.
So what could go wrong here, mate?
A lot of things could go wrong in this case. So the commodity price wasn't super friendly, as you'd kind of suspect, given it was at record highs, but it was the assets themselves in this case, and the kind of DD. I don't want to be too hard and say that the lack of DD, because they were suspect of the numbers that had been put to market by Riversdale. And you also find out from all these court documents later that there wasn't universal love of this deal within Rio Tinto. Not every voice was probably heard to, as it may have, as it probably should have been. But it's not as if everyone loved it. But at the end of the day, that's kind of how deals always end up happening in a big company. You don't tend to have everyone on board. Look at these maps here, and this is where it gets really, really interesting in how it just didn't stack up from a logistical kind of sense. The project lay a few hundred kilometres inland along the Zambezi River. Now, you've got this one railway line, which is meant to take it to this port, a bit under 600 kilometres. This had 5 million tonnes per annum capacity. This was meant to fully service stage 1. Riversdale at the time are just rehabilitating this track. They weren't actually building it new. It had been a historic track. You've then got this other one going in a slightly different direction and a longer route, 900 kilometres this one's meant to run, through Malawi, which makes it a bit more complex. And now this is what Vale, who were neighbours there, used for their operations. That had a few challenges with it. But here's the big one and the kind of most eye-catching one. They wanted to barge a tremendous amount of coal down the river. So this would be a 520 kilometre trip to the coast. Riversdale had been testing this. This was part of their feasibility studies for stage 2 and stage 3. The deal assumed that they would in time be able to barge 30 million tonnes per annum down the Zambezi. And anyone that's kind of seen the Zambezi can see it's a massive, massive flowing river, but that is an enormous amount to be barging on any river. So, yeah, that was a very big assumption. And added on top of that, they wanted to be railing 12 to 15 million tonnes down the track. This is sort of 2020s time frame that they're putting on that. But, yeah, that's sort of check 1 on the big assumptions. 2 was the quality of the coal itself. So they assumed about 60% would be hard coking coal, and that didn't pan out either. So this timeline starts slipping very soon after the deal. It went from being that September 2011 quarter to December to March. By the first half of that year, 2012 now, they just need to get something on a rail cart and get it out so that they can say they've met first production. But, it's in the detail here. Efficient transportation is a priority on the front page of that announcement. They knew things weren't going well on that front. Into the next quarter, so we're in late 2012 now, the railway continues to be a bottleneck. At the end of that year, the final quarter, still just 100,000 tonnes. That's nowhere near what it should be. And then bang, you get this massive bombshell that Rio drops. After providing, to be honest, pretty scant information, you're able to do that when you're Rio Tinto on the actual state of the operations. Through most of 2012, they come out and say Rio expects to recognise a $3 billion impairment on Mozambique coal.
Wow.
This is less than 18 months after the deal was wrapped.
And what they pay for?
They paid $4 billion-ish.
Wow.
So,
Then plus your working capital. And
they'd sunk a shitload of money into the thing.
Holy shit.
Yeah, so obviously that wasn't all just everything going wrong at the operational side. You had the commodity price, which forces the impairments often, and you have to reassess it against your carrying value. But they admitted that the development of the infrastructure to support the coal was way more challenging than they had originally anticipated. And to cap it off, they hadn't even got approvals to barge anything. So even if it was feasible, which it wasn't, to barge 10 million tonnes down, the government were saying, nah, you're not doing it. So this leads to a whole bunch of headaches because Rio knew about this way before they told the market. You got the Rio VP of Logistics believing that the absolute limit they could potentially do would be 10 million tonnes while they're talking about this up to 30 kind of number. And you've got, hydrogeological constraints and a whole box of other constraints physically that would stop you from doing so. So to put the boot in, they say that the reserves are far less than what their DD had even estimated. And if you think that their DD had estimated the reserves being half of what Riversdale had put out as reserves, you get a relatively small number. And again, that quality of coal was less than anticipated as well. So a year later, you get another $500 million US write-down.
Jesus.
Disaster.
So what were the final numbers of what the reserves actually were?
They came in at about 3 billion.
Jesus. And Riversdale had claimed 13.
Yes.
Yeah. That's nasty. And the logistics constraints, so they were trying to refurb an old rail. Did that just prove to be like impossible to do to the capacity that they wanted?
Yeah, to the capacity they wanted, they couldn't get there. But it just wasn't economic to do it. At the end of the day, they could have if they sunk even more money, but with the commodity price falling off, with the coal not really being there, looks
because coal then embarks on this like almost decade-long trend of just going like lower and lower and lower.
Yeah. Look, you can see this chart. I'll chuck in. It's to the commodity lows at early 2016, just a one-way sort of street, which is not good for anyone involved in the industry at that point in time.
Jesus, look at it go off in 2017, but that's unbelievable.
Yeah. Well, talk a bit about the Riversdale sellers who did quite well. So
what was the fallout from it, JD?
So obviously you got the impairments. That looks pretty rough. They ended up selling the assets in 2014, just a few years later for $50 million.
Wow.
And 2016, they sell that South African operation that was undisclosed. What happens to the Riversdale guys? You've got O'Keefe merged a business and chaired Champion Iron. So he's doing quite well for himself these days. They picked up a sort of reincarnation. They could have called it Riversdale again. They picked up Grassy Mountain, which they sold to Gina for $600 million, 2019. A few people might remember that one. But here's a cracking quote from one of the other founders of Riversdale. We were a company with $500 million in cash. We had rail, port, wagons, and the mine was already developed. The wash plant was going, and they still managed to screw it. Rio paid a heap of different settlements with the SSE, with people in London, with ASIC as well, for their lack of disclosure. And hence a lot of info came out of this deal because of all the court orders. So that was very interesting to kind of read into. But there was this kind of one bit where the internal technical team is starting to run the numbers, I think only in 2012, and they come up with a negative 300 million to like negative 5 billion NPV for the project a year or so after they bought it. So there was some intense emails sent around, as you were able to read a bit later.
There must have been, like a real hard look at yourself internally at a company as big as Rio Tinto when something as substantial as this just kind of gets across the board approvals from a technical perspective.
Yeah, absolutely. The CEO who was sacked, and it's kind of make more sense when I talk about the other stuff, but there was a lot of factors going on here, said on the Riversdale front, the biggest fault at his feet was that the resource and reserve didn't stack up. If you're trying to sort of piece together all the various things that went wrong on this front, but there was faults in a lot of different parts. Commodity cycle, DD. I think the saving grace is the relative size of this deal versus Rio. Like Rio's booming, coming in that sort of 2010 period again, like most miners were. So while it was a insanely abrupt write-off, it didn't kill the company by any stretch, obviously. So,
but it did cause people to fall on their sword.
It did indeed. A lot of the management team were gone when those write-downs happened.
Yeah, right. God, is that deposit being mined? Or did it get mined eventually?
Those deposits, I want to say, are in Tata Steel's hands again.
Yeah, right.
It's a very interesting cycle here. Ken Talbot, there's very interesting history through the 2000s, a sort of Queensland coal magnate. He'd had his feet in these assets as well and ended up kind of selling out a bit before a deal here. He was a billionaire anyway, so it didn't matter. But these assets had a lot of interesting history and the related ones, the tenements and what sort of touches on them in other parts as well.
Yeah.
A long history, but not being mined to the standard that anyone thought they would be, no.
Right, good stuff, mate. Deal number 2. Now, you probably could have taken your pick from this company.
I could have, yeah. St. Barbara buys Atlantic Gold. Deal number 2. This is the most recent deal on the list, and normally you'd want to give it a bit more time, but I think sort of 5 or 6 years is enough in this case. But you're quite right, Matty. This was a toss-up between a 2012 deal, which they did to buy Allied Gold, which is a complete clanger. That was how Simberi and Gold Ridge came into the fold there. Paid a 90% premium at the top of the gold market.
Yep.
Went horribly wrong. But I sort of thought they ultimately came out of that one and were able to have a run-up in share price again. And they had that experience. They knew what doing a deal was like in the company. I know there was different people and so on. But given that, I thought I'd talk about the Atlantic 2019 deal.
So was the Gold Ridge, was that the Solomon assets? The ones in the Solomon Islands?
Yes.
Yeah.
So
they've sort of got half of it still.
Yeah. There's long history, as there always is with these assets. So I'll give a bit of context on this deal. We're going to March 2019. Prior to the deal, St. Barbara is kept at a bit under 2 billion Aussie, operating Gwalia and Simberi. Together with those assets, about 400,000 ounces of production, all-in sustaining costs below $1,000 an ounce. Then you've got Atlantic. Pre the bid are capped at under $600 million. They operate the Toquo. I'm sure I'm pronouncing that one wrong.
Torquay?
Could be.
Could be.
It's sort of part of the broader Moose River project in far east Canada. So Nova Scotia is where these assets sit. Very importantly, 3 development stage assets are a part of this. They play a big role because they were meant to come online and they were meant to help them achieve economies of scale on that shared infrastructure and pull down the costs. So they were doing about 90,000 ounces at the time. Very importantly, the company sort of promotes a 12-year mine life when they're pitching this deal, but that operating mine has only really got 3, 4, 5-ish years in it. So that's factoring in everything coming online. And this was not a commodity price disaster. Gold was at US $1,300 at the time, and we all know where it is today. So that was not what went wrong on this front.
Wow. So what was the actual deal? Like, what did it look like?
It looked like an all-cash consideration of $770 million. Atlantic had some debt, so the implied EV is about 850 million Aussie. They offered a 40% premium to get this one over the line. At the time, they launched a $490 million capital raising. So they had cash reserves of $380 million and no debt going into the deal. But they end up signing up this $200 million debt facility as well, which they don't tap into just yet. Atlantic directors controlled 32% of the stock, so that helped things get wrapped up relatively quickly. It was only a bit over 2 months from when the announcement to the deal being finished. What they thought they were kind of getting into was low-cost operation, spreading their jurisdictional risk, and, the flavour of the day then was Aussies going to North America. The ounces are cheaper over there, and we can do it better. That's kind of the mindset that not just St. Barbara had, but a lot of the miners had at the time. And they were M&A hungry. Like the CEO said, we have enough to keep us busy for the time, but we're looking hard now that we've got a foothold in the region. They were M&A hungry and they wanted to do deals. Talking about the share issue, they hand out this new stock at $2.89 at a pretty standard discount, but they had been trading over $5 in mid-2018. Now, there was a lot of controversy about this capital raising. It did not go smoothly by any stretch. So St. Barbara actually ended up allowing the retail component of that to withdraw their bids because they had a production downgrade during the time frame. So the insto money's been taken on board. You've got $130 million raise going to retail. Most of them have put the bids in, and they end up saying, hey, you can pull them. Of course, pretty much everyone does, because at this point they're trading well below the issue price. You got Deutsche Bank as the underwriter here, and as they tend to do, they've got a bunch of hedge funds being the sub-underwriters. That's very commonplace, but it's not so common for it to go so badly wrong.
$135 million is that retail component.
Yeah.
Which is underwater.
So about $2.89, and the stock's trading like $2.50-ish.
Oh,
so pretty much every retail bid was scrapped, as you'd imagine, meaning Deutsche Bank and the sub-underwriters were on the hook for $130 million. So they had to give that to the company. And for some unrelated interesting history, this all happened in the same week that Dacian lost over 70% of its market value, and Gascoigne went into VA. So there was a lot going on in that week in the gold market.
Holy shit.
The gold price actually rebounded. So I don't know what sort of loss the underwriter and sub-underwriters had to take on this, but the stock price actually rebounded over the raise price over the next sort of 6-month period as we get to the end of 2019. So that's a open-ended question, which I'm sure a few people know the answer to out there.
And this is like when you're saying, look at what they were trading at. This was all this was after they went down to like 5 cents once they finally sorted
2014
the Solomon thing out. Like the people that made, there was truckies at Gwalia that made that much money buying shares at 5 cents. So they've recovered from all that and got up to, did you say $5?
$5.
Yeah, so 100x from those lows. And then this deal comes along.
Yeah, so this deal came along, Matty, and it did not go well from pretty soon into the piece. And it was a combo of financial mistakes, operational, and hugely regulatory problems. So Mine Life was very limited at that operating asset, like I said. So they had a lot riding on those development projects, and they were very aware of those problems. They just thought they could kind of handle them. There was meant to be this kind of staged transition as those assets came on in 21, 22, 23, and took them to 200,000 ounces in Nova Scotia. But that just didn't happen. You had huge environmental opposition and huge regulatory delays that held them back, and then the costs blew out massively. By calendar year 23, they were meant to be producing 200,000 ounces, and they did 28,000 ounces. So,
ouch.
Yeah, it didn't kind of meet the mark.
So all their fixed costs that they've got at this producing asset, and clearly de minimis feed.
Yeah, I mean, that asset went on care and maintenance for the second half of calendar year 23. So the last quarter of 23, they're not producing anything on this deal.
Wow.
By 23 as well, none of the permits had been received for those development projects. So almost from the off, they faced charges for not complying with environmental laws. That just didn't give them a good brand. You know, I'm sure they'd argue that wasn't true, but the perception of what they were doing there was not backed by popular support, and it was, you need your social license. It was very tough. The issues that they didn't come out of the blue. The previous company, Atlantic, had been battling with these, and there was this meeting about a tailings management kind of facility there. This was after the deal was announced, but before it had closed. And there was this kind of protester or somebody who didn't want it to go ahead, kind of being violently arrested as the headlines rang out at the time. So,
am I misremembering? The tailings like pumped into the ocean there?
Geez, they were exploring like dry stack and every option they could here. I'm not specifically sure what they were talking about in this meeting here, but you've got the boss of St. Barbara saying, I've got to prove why this is a good deal. So from the off, they knew they had challenges. And interestingly, on the social license, he had this comment to add that sometimes a change in owner or change of management can improve projects' social license to operate. So they thought that maybe them being a different entity would help the cause, which didn't turn out to be true in the end.
Imagine a Canadian saying that coming here, It's like, right.
Wouldn't smell good, would it? So within 6 months, one of the development projects, Cochrane Hill, saw it included in a designated wilderness area. That is never good for something you want to mine. Then you've got the financial strain, and it's kind of why I ranked this deal so highly, because it was too big a deal for the company to not go well. You can't do that big a deal relative to your size and it just go disastrously wrong, right? So from pre-deal to post, St. Barbara went from debt-free to with nearly $400 million cash to essentially neutral. So their positive sort of balance sheet strength is completely gone when they sign up for this deal. There was already production and cash flow at the assets in Canada, and that was meant to increase, but that didn't happen. And they were signing up for heavy capex. So they go to neutral balance sheet, right? But you've got 3 development projects that want to come online. You need to spend a lot of money, and they didn't have to spend as much as they thought because the projects didn't get the permits. But they were signing up for a lot of spending, and from the off, they were putting themselves in a kind of difficult position. So, like, you've got this asset that runs for about 4 years from operation. That's never going to pay itself off, especially when your growth ambitions are 2.5x that. So
presumably they're bleeding cash while this thing's operating too, because they're just not getting the ounces required to.
Yeah, I mean, to put the boot in, Gwalia just goes from bad to worse during this time frame. So that production downgrade during the deal was a Gwalia one, and then the same thing happens quarter after quarter after quarter for a while to come. So that went from producing cash and helping them out massively to being a very big burden. And then again, Simberi has its own downgrades, and they're running out of those, that oxide zone that they're mining. They're focusing or looking to focus on the sulfides. That needs capex and everything. And, in the face of gold just tearing higher, that couldn't even help them. There were so many things going wrong at the wrong time for this company.
Jesus Christ. So how's this is when the St. Barbara we sort of finished on commenced, wasn't it?
It is, yeah. It's kind of sad to see the state of the company now, right? It went so disastrously wrong in this case. Reflecting on the deal years later, the chair actually said that it wasn't the DD that went wrong, which is kind of what my first thoughts were, but he sort of pointed to COVID being a massive impact, to saying we couldn't get our boots on the ground there. Take that as you kind of may, I think COVID would have been a bit of a disruption, but clearly there was a lot of things that didn't go wrong in this case. And obviously speaking with the regulatory groups, with the First Nation groups, was one of them, but there were plenty of other things that needed to be done kind of better in this case. This company was an ASX 200 constituent when the deal was announced, trading at $3, $2 billion plus market cap. Still in 2020, they're at those sort of highs, and then slowly everything starts to catch up with the company. In 21, they start writing down the assets. By 23, over $700 million in write-downs. The asset itself is in care and maintenance. It continues to drain money while it's in care and maintenance. In the years up to 2019, like you kind of spoke to there, Matty, they had done a beautiful job. Like 2014 to 2019 was like a beautiful deleveraging of the business. They went from strength to strength. You sort of zoom out and see it. And they were even paying dividends, right? Like things were going gangbusters. And then this deal led to it all really unwinding in conjunction with Gwalia becoming the kind of asset it is kind of today, right? And Simberi challenges too. So mid-2022, they've still got a $1 billion market cap, but they don't have any defense. Like Genesis, which was for a long time a way smaller company, is just circling them. And because they're bleeding on all fronts, they've got no way of defending themselves. And I think everyone knows the kind of history on what happens there. So not completely fair to compare share price now and then, because you've got that distribution of 205 million Genesis shares that took place. But yeah, a lot of things went wrong. Again, the CEO left 5 months after this deal, and that was the CEO that had taken them through that awesome period. Like that, it was for unrelated reasons. I'm not sure what he could sort of see into the Atlantic deal 5 months later, but yeah, that left a board where not a single member had more than $300,000 in stock.
Yeah, wow.
At that time. So, when you think about incentives like we often do, it's a tough one for a company that's still a $2 billion company with kind of that minimal, relatively inside ownership in the business. So Yeah. This one really stands out, this deal to me, because it wasn't the commodity price that completely cooked them, right?
This was a bad buy.
It was a very bad buy.
They'd possibly still just be operating Gwalia, just like Genesis are. Like, I know they had the Bardock assets and everything as well, but like they simplified the business. They were producing cash, and that ore body continues to the never land.
Yeah.
It's obviously gets more difficult at depth, but they would have, just not been lost all their assets eventually. Like, had to sell all their assets.
It makes me think of people saying the expression, saying no is like the hardest, but one of the most important things you do, right? It's
Yeah.
what you say no to that really matters, because opportunity cost is enormous.
Yeah. I haven't scrolled to number one.
Have a guess.
Jeez, I don't know.
Should I reveal? Rio Tinto buys Alcan. This is...
Oh, yeah, I thought that was going to mentioned before, but I didn't know if you'd mention it to give it away.
This is perhaps, well, I think undoubtedly the most infamous deal in mining history, and it's the kind of archetype of top of the cycle deal making, paying too much at completely the wrong time. And all these dollar sums are going to be in US dollars that I mentioned here, so factor that in, because they're big dollar sums.
What was the context here, mate?
Mate, the context is the glory days. This is early China boom. In the first half of 2007, Alcan, Canadian aluminium giant, they're fending off M&A. The coffers of companies like Rio Tinto and all the other majors are just filling up because of everything going on in China. So they've got plenty of cash coming in the door, and commodity prices are just higher forever, as they like to say back in the day.
Stretch the chart up and to the right, and that's how you project the future. We all know that's how you make decision making.
Absolutely. And like you asked before, Trav, the framing for this deal was China needs three things. It needs aluminium, copper, and it needs iron ore. And we, Rio Tinto, are going to service all those needs. So that was the mindset they came into. And especially on the alley side, they wanted to be vertically integrated. Bauxite, alumina, aluminium. They wanted to do it all. And they weren't the only ones thinking this way. So Alcan reached all-time highs of $61 a share in May of 2007. And then you got Alcoa that come in and have a big swing, $73. So the stock at Alcan had peeled off a little bit. So this was a 30-odd% premium when they came in.
Were Alcoa bidding cash or scrip?
Couldn't tell you off the top of my head. Needless to say, a bit of a bidding war ensues, because Alcan come out looking for a white knight. They want someone else to take him out. And Vale and Rio Tinto lock horns, and they go to war over this one. And I just want to make a side note. Some of the charts from the late 2000s are just fantastic. Like, not sure if it's like Microsoft Paint or just PowerPoint back in the day. But that one with Shanghai in the background is one of my favourites.
The 3D charts?
Yeah.
So, oh, mate.
They're sick, right?
Bring them back.
Yeah. So the deal itself. In July of 2007, Rio make a cash offer of US $101 a share. That values Alcan's equity at US $38.1 billion. And this would create Rio Tinto Alcan. This was over a 65% premium to Alcan's all-time high 2 months earlier. So
Understood price. Yeah.
yes. Yeah. CVRD, which is Vale, and Rio had kind of got in a room together, and Rio ended up in, very kind of sarcastic quotation marks, winning out in this one and getting the right to buy Alcan. It gets bigger. That $38 billion was the equity value. They assumed nearly $6 billion US in net debt that Alcan had on the books.
Ouch. 44 billion US dual EV.
Yeah, so they're talking up synergies of $600 million a year. They actually raised this within a few months, and they say we can actually do US $1.1 billion in synergies if you want to put any weight to that. But here's the real kicker. The deal is going to be financed through newly committed bank debt. They put their buyback on hold, and they sign up a US $40 billion acquisition facility.
Oh my God.
This takes them to just about a US $46 billion net debt position. I cannot wrap my head around those numbers.
You can't get access to that kind of like debt these days.
Bring it back.
Yeah, like it was just a different time where everyone wanted to give you debt for deals.
Yeah,
but
so good.
that credit crunch soon came.
Yeah, so Rio straight away want to sell out this packaging business, but that doesn't happen because things go south very quickly. They wanted to sell that for over $5 billion, but they only get $2 billion for it a couple years later. The deal would make Rio Tinto the top player in aluminium and bauxite and a sort of pathway to being the top player in alumina. I need to speak about that net debt position once more. It goes from like a couple billion to 46 billion. Like, this completely changed the health of the business. And yeah, I'll get to how they frame it in a moment, but just stuff goes wrong from the beginning here. So like you said, credit was freely available and then it wasn't. And the door just slammed shut. Like, this was done in 2007 when you could get stuff like that done. And Alcan wasn't even a hugely profitable business. Like, its top line earnings were pretty comparable with Rio Tinto, but it didn't have WA iron ore. So its actual profit was, 1/5 of what Rio's was. So the fact that they would sign up this much debt is mind-blowing. Like, the profit of Alcan could barely even meet the interest expense they were going to pay on the deal.
At the time they signed the deal?
Yeah.
Wow.
It completely mind-blowing.
So you must have been forecasting a bunch of pretty absurd assumptions on alley price to substantiate this.
Yeah, so they talk about pro forma 2.8 times net debt to EBITDA. But then the price of the commodity just falls through the floor and that ratio kind of blows out, and they frame it well because that was the one covenant that they had. It was a net debt to EBITDA multiple, but it really starts to hurt them. And the company came out and sort of in August 2007 and like boasted about their ability to raise debt. That, just as a bit of a side note, is a red flag, I think, to keep in mind. Like, people will give you debt when credit markets are open, right? And it's your ability to say no and be strong and understand where you are in the cycle that you want to praise, not the ability just to sign up debt. Because people in the boom times will give it to you. So it was so
easy to get 50 grand to put into CFDs as a personal loan.
Bring it back, Matty. So the consequences. Very soon after the world turns south, Rio got the financing away and they had to issue in June 2008, less than a year after the deal, $5 billion in bonds. And then they just start chopping capex, laying off 14,000 people in late 2008, divesting heaps of assets through 2008, 2009 and 2010. They end up netting US $11 billion from these divestments.
I'm sure they're assets they wish they could have kept.
Yeah. I mean, commodity markets picked up relatively soon after, but gun to your head, because the first repayments of US about $9 billion was due 2 years after the deal, 2009. No one was interested in refinancing them. And the sole covenant, like I was speaking to before, was you got to stay under 4.5 times net debt to EBITDA. So here's where it gets super juicy, right? Shortly after Rio had bid for Alcan, BHP, in the biggest mining deal in history, came after Rio. This was a $150 billion hostile takeover. Nothing we'd ever seen before in the mining industry. And this was killed in due course through 2008 by the debt that Rio Tinto had taken on and plummeting commodity prices. So in November 2008, so this is a couple of months after Lehman has failed, Rio announced that the deal with BHP has been killed and Rio stock falls 40% in a day.
Holy crap.
In Feb 2009, they announced a joint venture and a convertible bond deal with Chinalco, who to this day are big shareholders in Rio Tinto, and they get a regular mention in investor meetings. So they come in and sign this deal to net them US $19.5 billion.
Wow.
But it's not done. FIRB did not like this deal. So give it a few months and markets start to improve. And on June 5, 2009, Rio Tinto comes out and says, all on the same day, that deal is off with Chinalco. we are now pursuing a $15 billion rights issue, Rio Tinto. This is after a 65% drop in its stock. And we are going to team up with BHP in WA Iron Ore and create this joint venture that's going to have an NPV on the synergies of US $10 billion.
Wow.
Yeah.
Okay.
And-
Competition though, mate.
Yeah, so very unfortunately, the regulator didn't like this one either. And that deal, not the rights issue, the rights issue gets away, that gets done, sort of fixes the balance sheet to an extent at Rio. But October 2010 takes a long time for that deal to kind of fall over with BHP. So what could have been.
So they did enormously dilute existing shareholders to pay out this debt to the tune of $15 billion at a depressed share price.
Yep.
Ouch.
Yeah.
Ouch. And I remember when we talked to Alan Clark, he raised the potential that, maybe the reason Rio paid so much and in cash and debt funded was actually a bit of a poison pill to prevent being gobbled up by BHP themselves.
Yeah, poison pill is a funny word, right? Like,
Yeah. It's like I'm gonna encumber
fucking
my
pill.
business.
yeah, I'm going to kill myself so they don't take me.
But maybe yeah.
Yeah.
Yeah, wow.
Yeah.
Is there any more on that one, JD, or you?
Yeah, I mean, a couple of bits of,
Since it's number one.
in the aftermath of taking on all that debt, the Alcan business itself just didn't do well. Like, there were massive write-downs, as you'd expect. About 25 billion US in the write-downs is the rough number that you can sort of read into on a $38 billion deal there. And of course, the CEO leaves in 2013. That was the same announcement with these write-downs that the Riversdale write-downs happened. So it all came out on a day that they announced, I want to say $14 billion in write-downs. So it was a bad day. Rio went from a market cap of about Aussie 150 billion at the end of 2007 down to 40 billion at the end of 2008. So they're moves you don't kind of see every day. And yeah, just that net debt, I think that's the lesson to kind of hit home and how you sort of think about managing that. I mean, it was relatively short-dated debt as well. Like I said, a quarter of it had to be repaid or refinanced within 2 years. So, I mean, they did that at a time when aluminium had just hit a 20-year high in price, and they never foresaw China entering the aluminium market the way they did.
China went massive there.
Yeah.
Absolutely massive.
Yeah. The opportunity cost of that deal is kind of like, it's very, very big, to say the least.
God, what a time for him. When was I don't know if this was around the same time. Remember the Stern Who thing for Rio?
No.
That was Rio, wasn't it?
I'm not sure what that one was.
It was like they were spying or something, China spy with Rio Tinto. I don't
That's
know
up my alley.
Don't know if it was around the actual same time. It just sounded like a horrible friggin' time for Rio.
Yeah. Oh, also in that China bit, there was a lot of very uncomplimentary articles about Rio Tinto written in China when they gave Chinalco the flick on that June day in 2009. There was some funny articles.
Yeah, well, this is it was 2009. He was a Rio executive pleading guilty to stealing commercial secrets and receiving bribes. That was all around the same. Not a good period for Rio.
But tough times make you tougher, right?
Eddie, so sensational, JD.
Thanks, mate.
Is it take a breath? Bloody.
Yeah, need one.
What's the honour? What would you say? The honour board or the
special mentions or something like that?
Notable
Or,
mentions.
there's a couple nickel deals that were done in recent times that are probably worthy of a mention. I think there's a few that. The ones that really
Jubilee would have been up there, wouldn't it?
Yeah, so the ones that really caught my interest were international deals. So that Jubilee, obviously with Xstrata coming in, there was a few other really interesting ones. The gold ones at the time, blanking on some of the names, but there was dozens.
Western Areas.
Yeah, they are the nickel ones. Yeah, absolutely. There's more than a few out there that are worthy of a mention, but I think we can leave it at 5. I think there's a lot of lessons to sort of sink in from those ones. Like the ones I'm kind of thinking of front and center, Matty, is like just how quickly commodity markets can change. They can change so much quicker than you can possibly imagine. And added to that, like the power of allocating your capital when you have a best-in-class asset is super important. That ties in with what I said about saying no to deals, because that's what Rio Tinto had, right? And you see so many shiny things flying by that the power of saying no and holding on is super, super important. And Trav, you mentioned this earlier, but looking at the percentage ownerships of management on the buying side versus the selling side is a very interesting one. So often the sellers, needless to say, had big stakes and they thought it was the right time to say goodbye. And these were kind of professional management teams on the buying side. So this plays a role.
Whose incentive structure might be bigger is more at times. Yeah. What other takeaways are there? I mean, I've noticed a couple themes in these top 5, including the punitive cost of debt when you get the cycle wrong and the deal wrong.
Yeah, 100%. Like debt can be a killer, and it's always underestimated. Like just listen to Warren Buffett and Charlie Munger and how they speak about it. They'll do it more justice than I. It's those 1 in 100-year events that you're trying to avoid. But to think your downside is limited to what you're paying is wrong. Your downside can be way more than just the price tag. Like whether that, firstly, opportunity cost, first and foremost, but then also the debt you're taking on and all these other things, the liabilities in some of these cases, it is not limited to what you're spending.
And sometimes you think, oh, well, it's, my market cap today, I can easily raise that amount in equity if I needed to fund the repayment of that debt if it all goes haywire. But you don't think that your share price is going to be 80% lower as a result as well. So your dilution is horrible.
Yeah, it's not there when you kind of need it. And yeah, perhaps just like really, really, really do your DD and listen to every technical financial person you possibly can, because you can end up paying a big price.
Another theme I noticed was a propensity to seek growth internationally where maybe your like core expertise might not be, or this like I'd call it a dubious rationale to do a deal is diversification of earnings into be it a different commodity or a different jurisdiction, but that in mining, like there's no synergies there.
Yeah.
It looks like they all went into unfamiliar jurisdictions to themselves.
Yeah.
Like most of them.
And just capturing more upside because the commodity price is rising is not a good enough rationale. It's like, no, that doesn't work. I should probably add in that I'm sure I've got details wrong in here, so feel free to get in touch, money miners. Keen to hear. I'm sure there's other people with vastly more experience than I who know of other super interesting deals out there. So very, very keen to hear those ones too. But
let us know the deals that you think of when you think of value destruction.
Yeah.
Be good to do like you could do a smaller end one, like, smaller deals that ruin small to medium companies as well.
Yeah. I think projects would be interesting as well. There'll be a lot of like technical learnings on that side. So maybe someone more well-versed in that field would be interesting. And of course, the 5 best deals would be an interesting one.
They're like, the 5
just
worst,
the reverse of these.
5 worst sales are the 5 best buys.
Yeah, 100%.
The 5 worst buys are the 5 best sells.
That's it. All right, lads, I think we should leave it there.
Buddy, how long did it take you to gather, or how long you been on this project for, JD?
I started last year, but there was a big hiatus in between. But it was just sort of out of interest. And I thought, maybe we can turn this into an episode or something.
Mate, it's like writing a book.
It was the longest sort of write-up since my uni days, I reckon. Yeah, it's good fun. It was very interesting.
Righto, we better thank all the partners. I don't know if I'm in a different shirt or something because this may be recorded later. But
no such thing.
If I am, whatever. So, discounted tickets going out the bloody door everywhere. AusIMM Underground Operators Conference, $100 off. Mate, you got discounts on the GRX conference in Brisbane in May. Mate, it's just all happening. And our great partners at Mineral Mining Services, Grounded, Sandvik Ground Support, CRE Insurance, K-Drill, WA Waterballs, Swick, Quattro Project Engineering, Cross Boundary Energy, JD, sensational.
Thanks, mate. Hoodaroo, money miners.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.